Portfolio Update webinar today. My name is Geoff Wilson and I'm Chairman of WAM Leaders. Thank you very much for dialing in. We've had a really good acceptance, a number of people that have registered and have logged into the webinar. I'll be joined today. I'll be giving a little bit of an update at the start, and then I'll be passing to Matt Haupt, Johnny Ayoub, part of the team that manage the WAM Leaders pool of capital. And also we've got April, who is from our, will be running the questions, the Q&A. And thank you very much for everyone who sent the questions in. As you know, this is your company. And if you have any questions, ideas, suggestions, please feed them back. Now, the reason why we're doing this webinar now, a number of reasons. One is, we've been speaking to a number of shareholders, and we thought it just made sense, to call this webinar to give them a good update, and also to look forward to 2025. There's a lot of uncertainty in the world, and just to give you a perspective of how the team is looking forward. Also, I think it's worth noting, I've recently been buying some WAM Leaders shares. WAM Leaders, about a year ago, was trading at a little over a year ago, about 10% premium to the value of the assets. And now it's trading closer to a 10% discount to the value of the assets. Now, I enjoy, or I like buying into companies that are trading below what they're worth. And to me, it's a good time for me to be buying, because at the start of January, the boards might decide to announce a dividend early, et cetera, et cetera. And also, you tend to find that when listed investment companies go ex-dividend, when they announce the dividend and then the run-up to the dividend payment, they usually outperform the market. And when they go ex-dividend, a lot of instances you get a situation where real value presents itself, and that's I think where we're sitting at the moment with WAM Leaders. What I'll do is let me pass over to Matt Haupt, our lead PM, and Matt can give you a bit of a snapshot of what he's seeing ahead. I'll pass it to you now, Matt.
Great. And thanks, Geoff, and thanks for all the shareholders joining us on the call today. I thought it'd be a good chance, like Geoff mentioned, around having a look into 2025. Obviously, a lot's been going on and there's a lot to happen in 2025, which will shape how the investment landscape looks. So I thought it'd be a good opportunity on this webinar to walk you through some of our thoughts. Obviously, as things come to light, our views may change. So this is how we see the world as we speak. But first of all, it's probably a good chance to reflect on valuations. When you look forward, you've really got to work out what starting point are you coming from. And the starting point, when we look at valuations, they are extreme. So they're extreme on when we look at PE ratios. They're in the 98th percentile over the last from really the last 40 years. So we are starting at an extreme valuation starting point. So you have to take that into account when you're looking forward. But I'd say what we see in the first quarter is going to be a lot of volatility. And why do I say that? It's really around Trump coming into power in the US. So what we've seen previously and what we're likely to see, almost guaranteed to see, is the start of a global trade war. So Trump has said in the past that tariffs are an effective policy tool. So what we're going to see is announcements in January around tariffs on the rest of the world. Predominantly China will be the target, but the rest of the world will not come unscathed. So we're likely to see a lot of volatility come into the market in January and February. And the market is not positioned for this volatility. What the market is positioned for at the moment is a soft landing scenario with an interest rate cutting cycle factored in, and a very solid earnings outlook. So we're going to the start of the year rather cautious, and we've wound our cash up to around 5 to 6% on the back of this expectation of volatility coming in. But what we will see is interest rates moving back from restrictive levels back to accommodative or neutral levels. All central banks have been on the battle of targeting inflation. So what we're seeing is interest rate hiking cycles and the commencement of cutting cycles. There's about 125 to 150 basis points, or 1.25 to 1.5% of interest rate cuts that will come back in. And that is just to move us back to a neutral position rather than a restrictive position. So we think that will come into the market, which again, the market is already factoring in this. So that's why valuations are extreme. And that's why we think the interest rate cycle is largely in market at the moment. What we will expect to see as well is in March, more stimulus measures from China. So China has obviously been a big underperformer for, ever since COVID, really. There's been talk of stimulus a few times, and nothing was really delivered in any meaningful manner. What we see now, though, is the government are acutely aware of how bad the economy got. The property market was a deliberate attempt by the government to slow down speculation, and that's been part of a 5-year plan. But they've come to the end of this 5-year plan. The local governments no longer have control over spending, so the central government is effectively in control of these local governments now, and the development market in property in China is very much state-owned enterprises. So mission accomplished, and they're moving on now. What happened in China was in the third quarter of this year, there was a huge slowdown in consumption, so the government had to pivot. So what we expect in March is a pretty big stimulus announcement around the party Congress meeting, which will happen in March. So we're beginning to implement more resource positions in our portfolio, cognizant of a trade war, which will throw up a lot of volatility, but that creates opportunity. So we actually don't mind volatility. And if we look at the markets, like what's going to break the markets at the moment, and we can't identify anything in the short term. Valuation alone is not enough to break the momentum we're seeing in the market at the moment. So what we think will happen is it's just going to be around probably sub-historical returns for the equity market. But that doesn't mean we can't outperform in that market. We actually quite like those markets. The full-blown momentum markets we find harder to keep up with. Rather, the market we're moving back into in 2025 looks a lot more attractive for us. There'll be a lot more volatility and a lot more opportunities to utilise our approach, which is more on that nimble approach, swinging between different factors, between the macro, the fundamentals and positioning. I'd characterise this market as all positioning, all flow-driven. It's a very peculiar market. It's like the last 3 months in particular have become extremely overextended in a few names. So we think this reverses, and once that reverses, that same upward momentum we saw will happen on the downside. So that performance we lost with, let's say, the banks, we think we'll get all that back and more on the way down, because from a fundamental point of view, they look extremely overvalued. So we're actually pretty excited about 2025. We think the market will move back towards an environment where we can really add value. We think there'll be a lot of opportunities, and like we said with China, the way we view China at the moment is you trade the optimism, or you sell the optimism and buy the pessimism. That's the correct way to play China this year. And on the tariff front, it is quite negative for global growth. So global growth will decelerate this in 2025. We were talking earlier, and we'd probably characterise 2025 as the year of moderation. We think all things will moderate: equity returns, inflation, interest rates. You could really characterise it as a year of moderation, 2025. And for us, that presents great opportunities. So I'll probably stop there, and I'll hand I'll hand over to John to talk to Geoff. Sorry, back to Geoff.
Yeah, I think we sneak back to me for a minute, then we'll go to Johnny.
No problems.
I mean, that was sort of the big picture, and because I think we're coming back to me for a couple of things. The disclaimer, which I skipped over. This is just general advice. Are we putting this up on the screen there, April? Or so we're giving you general advice. Please read the disclaimer, and also I just on the slides that we'll announce to the ASX, and we'll send out to shareholders. To me, it's just to focus on some of the high level points. Obviously the share price now, as I said a year ago, is trading at a premium to NTA. I mean, since it's been listed, WAM Leaders traded at premiums and discounts. On average, over that period of time, it's traded an average 2% premium to NTA. So, this is the biggest discount it's been to for a while. And we think we understand that. Ex-dividend, the boys have been taking a conservative positioning on the portfolio, where it's been a momentum market. As Matt said, some of these valuations on the banks, trading, like the bank's trading on 4 times, their asset backing is, in my lifetime, I haven't seen it. And unfortunately, when you haven't seen things in your lifetime, they tend to revert at some point in time to what you have seen. So the boys are focusing on making sure they're looking after your capital, and so we'll go through that. And also, it's worthwhile pointing out, the current yield that the guys can deliver on the portfolio from the profit they've made over time and the continued profit is nearly 7.5%. It's 7.4%, and that's fully franked. So if you gross it up, you're getting a performance. You're getting close to that 10%. I think a little over 10% on a grossed up basis. And also, to me, it's interesting. Matt's talking about the period today, and there's another slide that we've got in terms of just goes through the 2019, 2020, 21, 22, 23, and 24 performance numbers, and you'll see how the 24 performance underperformance by 9 and a bit percent, and 23 is smaller underperformance by 1% or 2. But back in 22, a 16.2% outperformance, 21 a 9.2% outperformance, and 20 a 10.4% outperformance. So, as Matt alluded to, in a market that's that is more challenging rather than momentum based, and pushed by the sort of the I was going to say the dumb money, but I probably shouldn't say that. It's the money that's just going into the index funds and the momentum traders. That always reverts at some point in time. So to me, I think they were the main points. Also, we put a little comment. We've added a slide in terms of just showing you some people with listed investment companies don't fully understand that we have to make money to pay these dividends. In terms of how do we make money, the value of the portfolio goes up, and because we're paying such a high dividend relative to the market, we've included a slide which just adds the dividends that we've paid out to the share price. So that's if you'd stayed, effectively gone into the dividend reinvestment plan. Well, actually, we haven't assumed you've gone into the dividend reinvestment plan because you're getting another benefit of 2.5%. Because it's the discount. But we've shown you that figure. I think it adds, depending on what period of time, 70 odd cents to the share price of dividends paid out over time. Now, I think now I'll pass back to Johnny, and you're going to drill in a little bit more on the companies, aren't you, John?
Yeah, talk about the portfolio a little bit more. So thanks, Geoff, and thank you, everyone, for joining us at this time of the year. So hopefully we haven't pried anyone away from a Christmas party or anything like that. Maybe just on the portfolio and the way that we've shaped the portfolio recently. As always, we've been working very busily in the background, rotating the portfolio and trying to find some opportunities. The main areas that we've changed positioning is, for the first time in a very long time, we were underweight the oil space. We decided to do that over the last couple of months. And the key characteristics of the portfolio today are very much around that China thematic that Matt was talking about. How do we get access to the China consumer in particular? Because what we do think is when that stimulus does come, it's going to be very much focused on consumption and driving Chinese consumption. And for us, the main themes to play are Treasury wine and A2 milk. A2 has had some impacts around birth rates, but what we do see is potential for some stimulus to drive, regenerate the birth rate in China, which should lead to some positivity for A2 in the short term. Equally, Treasury wine, after a hiatus out of that market for some time, early indications have shown that demand for Penfolds product in particular is very strong, leading to first, second, even third reorders of products in a very short period of time. So for us, we think those two have some great runway ahead of them from an individual stock perspective, but even and with the backdrop of thematic doubles our conviction around that positioning. And then from the resources perspective, we think naturally they should bode well as China stimulus starts to take hold. In particular, we're focused on those commodity-driven, consumer-facing commodities, and they primarily being aluminium and copper. And the ways that we get exposure to that in Australia, particularly South 32, Rio Tinto, Capstone, Sandfire, they're the main names that we're focusing on. Equally, and we've just started to initiate some small positions back in lithium after we haven't owned lithium for quite a while. We did have a small dalliance, I'll say, with Mineral Resources back in September. We traded it quite well, but we got out. But we're back in there in a small way now. And Pilbara both seem to be attractive from a valuation perspective. We think we've seen probably the bottom of the lithium market. Not to say it will run away, but we've probably seen the bottom. The rest of the portfolio, I guess the way we can characterise it is around defensive attributes, good quality, fundamental companies that most shareholders would know. Those names would be Telstra, QBE, Coles, IAG, Sonic Healthcare. Household names, cheap valuations relative to other pockets of the market, have some earnings tailwinds as well. So we're really attracted to those stocks right now. They represent some really good value and attractive opportunities. And then the last sector, or the last thing I'll talk about, is just the discounted place, things that we think have been unduly struck down, have some good NTA support, asset-backed, have been flow impacted, and those names that I'll call out would be a Dexus, a Challenger, and a Spark, which is a New Zealand telco. They're the names that we're really attracted to in the portfolio. It's also probably worth highlighting the names that we've taken what we call underweight positions, that we've taken somewhat of a negative bias toward, and those are predominantly the banks. Matt will probably give a drill into each of the banks individually a little bit later, but at the current juncture, and at the forefront of everything we do is capital preservation. And where we see the banks, albeit they are wonderful businesses, in particular CBA, as Geoff was pointing out, as Matt will point out later, the valuations just don't lend to us having a material position in those, particularly given they make up about 25% of the index. CBA makes up around 10% of our investment universe, and trading above four times book value and a yield sub 3, that just doesn't represent value for us. Whilst we prefer to own a Telstra, which has a lot more positive attributes, growing strong with stronger growth characteristics, we prefer to hide there. So that's probably the way that I would characterise the portfolio. Another stock I'll call out, and obviously it's one of the controversial ones that we've had in our portfolio, Star. We've managed that position down to sub 1%. We've taken a number of learnings from that one and implemented across the portfolio. It has saved us some money in not owning things like Endeavour and Woolworths. From those bad calls, there has been some positives that we have taken, and we've taken those lessons and implemented them into the portfolio. So we're very pleased with the way the portfolio is positioned today. We think there's a lot of opportunities, even if we see a sell-off or a rotation, and we think a rotation in the market is more likely in the short to medium term. And we're very, very pleased with the way the portfolio is positioned today.
Yeah, I'll just add as well, I think we both characterise this market as dysfunctional at the moment, the way the money has been allocated, and the way valuations and stocks, even within the sector, is very distorted. So the flow of money is very, very direct on a few names. So we'd actually welcome more volatility into the market, because we think that would be a catalyst for the market to return to more sensible application of where funds are flowing. So, and we think that will happen in January. The market is not positioned for any type of sell-off. And the way we judge that is we look at volatility, and volatility, the measure we look at on equities is the VIX, and also for bonds is the MOVE index. Both are really, really low. So the market is not positioned for volatility, which we think, and we're almost 100% sure will happen in January. So we think that will be the circuit breaker for this craziness to end. And I would describe it like Geoff talked about never seeing in his career. I mean, I wouldn't even dream of seeing a bank at 4 times book value. I mean, like they're writing loans at the cost of capital, which you should only pay 1 times book value for. We love the banks, the CEOs. We think they're great. Great businesses like John described, but from a valuation point of view, it just does not make sense. So we'd actually welcome that. And from the portfolio construction year, we've moved it more defensive. The reason why we moved it more defensive is if we look at these indicators like the City Surprise Indicator, which sort of judges, is the economic data being market expectations? And it has been for the last year. So I'd characterise this market as being incredibly resilient, and there has been positive economic surprises. What we think will happen now is we'll start to get some negative economic surprises, and that will help with this rotation out of this these names. So we think earnings growth will be lower, global growth will be lower. We think valuations, even if they hold, the earnings won't grow fast enough to make them more sensible. So we think we've got all the ingredients here for a classic stock picking market, rather than I won't use dumb money, but I'm not sure what the right term is, but maybe it's just momentum following market. It's probably the most polite way to say it. There's nothing wrong with that strategy. That strategy works in particular markets, but we do follow that sometimes. But when the fundamentals move too far and are stretched, that's when we step out of the market, and that's what we really did this at the back end of this year. We from a fundamental point of view, you can't invest in these companies. I characterise it as 100% being flow driven, and the way our investment process work is around we look at the macro, the fundamentals, and positioning flow. So we do look at it, but I'd characterise it as almost 100% sensitivity to flow, rather than the macro and the fundamentals. So when you have that divorce from those factors, that is an anomaly, and it will revert. And the greatest lesson in markets is you always return back to the mean, or in most situations. And in life, it's almost like the cycle of nature, return to the mean. It happens in most things. So I think what we'll see next year is 100% will return back to the mean on some of these anomalies we're seeing in the market at the moment.
It's probably worth also highlighting that the market always gives us a clue as to the way that other funds are positioned. And early this week, when there was the surprise announcement around further Chinese stimulus, our portfolio made 50 basis points in a day. Shows how sensitive our portfolio and is geared to a certain direction of the market. When CBA was down 1.5% or 2%, we're generating some really quick returns in that portfolio. And to demonstrate, the last time that happened was when the currency issues were happening in Japan, and CBA fell 6%. We were making 100 to 150 basis points in a day. So the market is very sensitive to any sort of directional change. We've already made that change in the portfolio. We've pivoted it early, somewhat too early, many of you would say. But when it does turn, and as Matt was saying, we are confident the market will rotate, we'll make a lot of performance very quickly. The other thing to also stress and highlight is when we talk about momentum markets, just to kind of provide a bit of perspective on that, typically in markets, you're trying to look a year ahead. You're trying to identify where a company will be, where valuations will be, where earnings will be 1 to 2 years ahead. The market isn't concerned with that right now. They're so fixated with the next announcement. The next announcement being the earnings update or whatever it might be. As long as it beats or misses that, that's all the market is fixated on right now. So it doesn't really care about the valuation from 1 to 2 to 3 year perspective. It's only really focused on that short-termism. And for us, when the market pivots to that, that's when surprises and shocks can take place. And we're really cautious, as we said earlier, about capital preservation. And we're not going to chase that really, really short-term gain because the consequences of that on the other side are dramatic. So that's the way we're feeling at the moment.
It's quite an important point as well. The market will give you signals around when a change is coming. You'll start to see days where the old trades start to fall apart, and we're getting that probably once every 3 or 4 days now. You'll start to see a day where that momentum just dies, and you're seeing some decent drawdowns. So, and the market often gives you these clues ahead of time. You'll start to see it slowly creep into the market, and then all of a sudden it happens. And these inflection points historically are where we make a lot of our performance on these inflection points, and we think we are at the right on the cusp of an inflection point, in the next month or so. So, we're actually quite excited about that chapter ending actually on momentum.
And thanks for that, both Matt and John. And I know we'll go to April now from the investor relations team for Q&A. But a couple of things, John, I know you were talking about 100 basis points to turn that into English, that's 1% or 150 basis points, 1.5%. And Matt, just there, you were saying you think we're on the cusp of, was that just a move from the passive money, running just looking, effectively just following the herd, effectively?
Yeah, correct. And normally, you need to see a specific catalyst to change it, but we're starting to see it fall apart already. But the catalyst we are expecting is the launch of tariff theatre in January, when Trump's obviously going to come in. So we've got a clear catalyst for this trade to unwind. So we're actually very confident of that, because normally you'd hope just through the passage of time will work, but that is a much lower conviction that it will happen. But we've got a clear catalyst, and that's what I should have gone into the detail. The cusp is Trump coming in, global trade war, disrupting all the flows. So that's where we think we're heading.
And what does that do for Australia, or does that for the Australian equity market?
Well, the first thing, the way we're looking at it at the moment, we think the first thing is a stronger US dollar will happen. So, we've got to look at the sensitivity of that portfolio to the US dollar. We've got to look at, commodities are generally negative when you've got a rising US dollar. So we've got to take that into account. And the target is likely China. So, we're quite positive on some of the resource names, but they're probably going to get hit. So we will reduce those into that. What does it mean for Australia? We probably won't target Australia with explicit tariffs, but obviously the impact to global trade is fairly large. You can talk around, it might hit the global growth by 0.5, so of 1%. So it's actually quite meaningful. And also consumption in the US, effectively a tariff is a consumption tax anyway. So as much as Trump says the rest of the world are going to pay our tariffs, it's the US consumer that pays it. So we've got to look at the impact on Australian companies over in the US and counter that with a stronger US dollar. So the impact's quite limited on Australia. The Australian dollar probably falls as well, as the Australian currency is a proxy for China. So we'd expect Aussie dollar to fall. And again, we'd look through, we've got all the sensitivities. How does a lower Aussie dollar affect our investment companies? So there's a whole range of how it'll pass through.
Yeah, the only comment I'll add to that is just that China and the rest of the world have a glimpse into the Trump playbook. They've seen it before. So potentially we're better prepared for it this time, in particular China. I think when you look at the stimulus that they have been announcing, it feels like they've been rather reserved and held back on that. And I think they're waiting for some of the finality around what the trade wars potentially and what the tariffs look like before they pull their gun out of the holster, so to speak. So for us, we're trying to work out the size of the gun. Do they pull out the pea shooter early, then pull out the bazooka, then pull out the real big cannon? We're trying to work out how they step through it. And there are potential for Trump to actually find other parts of the world to get those tariffs. And he's invited the premier to go to the inauguration. So it's a step in the right direction. So we need to be conscious that we know what the playbook is, and potentially there are different directions that could take place. So we're sitting here and managing and looking at it every single day.
Yeah, but I guess the takeaway is it's bad for global growth. And the volatility will be bad for equities in the very short term. And that's why we think that's going to be the catalyst to interrupt this flow.
Got you. Thanks for that. And I know we've already had a lot of questions that have come in. Why don't I pass over to April, who can allocate the questions out between us? Thanks.
Thanks, Geoff. I'll start by running through the questions that were provided ahead of time. So we'll start with Jeffrey and Tony have both asked questions on gold. They've asked, what is the gold exposure in the portfolio, and are you long gold stocks? And that's one for Matt and John.
Yeah, great. I'll kick off. So gold we've reduced. We were actually quite heavily overweight gold throughout the start of the year and mid-year. So we were running about almost close to 4% of the fund in gold. And obviously gold had a great run. We've reduced that down to sub 1%. So we do have some Newcrest, Northern Star, Vault, and Gold Roads. That's what's left, and it's sub 1%. So our view on gold is not as positive as it was, and predominantly we think the interest rate cutting cycle, the real rates have probably done all their movements now. So for a catalyst to go long gold from here, we need to see something else, which we can't see in the market at the moment. So, what would get us positive on gold? It probably, if the US deficit were to blow out again, like what was happening was US is running like 7% deficits, flooding the world with US dollars. Scott Besson came in, the Treasury appointee. He said, we're going to wind back the deficits, and that killed the gold trade. So we need to see US deficits blow out again to get positive on gold, and we're not likely to see that in the very short term. So for us, we'll run a little bit of gold in the portfolio because we talk about low volatility, that might spike, but we can't see a clear catalyst from a macro perspective to go long gold at the moment.
From a stock perspective as well, it's been a challenging time for all the producers. We've seen cost overruns and mining issues and grade issues, and it's been challenging to get the leverage that you've wanted from a number of the stocks. And our default position for a long time was Northern Star. When Newmont got sold off, we rotated to Newmont. So hence why we've got the Newmont position. We took a basket approach to a number of the mid-cap names, and that included De Grey before the takeover and Vault and Gold Road, because we wanted to go towards that, because there needed to be a catch-up trade, and we've seen that now. So from a stock perspective, if we had to, the one that we're happy to hold now is Newmont, given their catalyst rich from an asset sale perspective.
Thanks. We have a question from David, who's asked, would you consider converting WAM leaders to an ETF so it trades consistently at an NTA? If not, why not? And I think that's for Geoff.
Yeah, no, thanks, David, for the question. And the board looks at capital management each time it meets. One of the negatives, well, to me, one of the holy grails of listed investment companies is the fact that they do trade at discounts and they do trade at premiums. I mentioned earlier on, I think the average premium for WAM leaders since it's been listed, not quite a decade, has been about 2%. It has, I think it was September last year, it was trading at about a 10% premium. So if you turned into ETF, the best you'd get, the best and the worst you'd get was NTA. So it's an option that we have. We haven't decided to at this point in time, and I wouldn't be that keen on it. And I was talking to one of the other WAM team members earlier today, and they said they were talking to a shareholder they're making some calls, just touching base with shareholders, and the one they called was a little bit upset they were calling because he said, "I actually don't want you to call because then the discount, that means you'll be explaining to people what's going on and that I'm trying to buy some more, and I'd prefer the discount to be there." So to me, it's like you've got to understand you're buying a listed investment company. One of the things that a lot of people don't spend a lot of time on is one of the reasons we started with this structure. We also have an open-ended structure. If you prefer to invest in something where you can get in at NTA and out at NTA, WAM Leaders does have that. So just send an email into the team and they can help you there. So that's probably enough.
Thanks, Geoff. And another question for Matt and John from Tony. What sectors do you think will benefit from Trump and what sectors will be affected negatively?
That's a great question and one we ask ourselves every day. I'd characterise it between short-term and medium-term, long-term as well. So it's going to be, I'll try and flesh it out a little bit more. So in the very short term, we think Trump is very US dollar positive and US economy and US company positive. So I think in the short term, sectors, like the way we look at it on the ASX is we look at our companies which are exposed predominantly to the US dollar and US economy. And, some of the big ones, that like people will know would be like Aristocrat, James Hardie's, Brambles, Amcor, things like that, or companies like that, they appeal to us. And then we're obviously got to go down to the fundamental view of the companies and do all the analysis on that front. But instead of because our exposure, we can't really go through a sector based approach with Trump. If we're operating in the US, we could. So we don't look at it from a sector perspective per se, but more of a company opportunity and where do they earn their money and their geography exposure. So I characterise it as that. On the medium long term, I think what will happen is effectively Europe is going to be a big loser in the short term from Trump. So I think that's going to create a lot of opportunities for, again, not from a sector perspective, but from company perspective for us within Europe. So companies with big European exposures and, companies, again, like Brambles have got a big European business. There's other companies which we own like Reliance and a few others that have European exposure. So I think that will happen. But ultimately, in the short term, from a market perspective, I think being defensive in January is probably going to be your best bet. So we think the low beta names, and what I mean by that is stocks that don't move as much as the market. So, more resilient, consumer staples are probably not the area at the moment with the ACCC focus and Woolworths having their issues, but, things like Coles looks okay. Telstra looks really good to us. Spark New Zealand is another one. So I think that defensive part of the market is where you want to look. And then as we roll forward, then you want to roll maybe into a bit more cyclical, like consumer discretionary, even at the back end of the year when, tax cuts are always going to kick in. Both in Australia, we're going to get more of the tax benefits rolling through, and the US, you're going to get more tax benefits rolling through. So then you probably want to pivot later in the year to more of the even manufacturing, cyclicals, more stuff that will pick up at the back end of the year on from a sector perspective.
Thanks, Matt. And I think that also covers the next question that was from John on companies that would benefit from a Trump presidency. So we'll move on to a question from Tony. So Tony's asked for your views on a few companies, including Clearview Wealth. The ASX ticker is CVW, Perpetual, PPT, and New Hope Corporation, NHC.
Thank you, April. Tony, good to hear from you as always. Clearview, we'll park that one because it's not really in our wheelhouse. It's outside the 200. It's not something we spend a lot of time on. Perpetual is an absolute battleground stock right now, and following that tax ruling that came out yesterday, it's thrown a lot of balls up in the air, and primarily does the deal that was announced with KKR complete. So you got really two big questions around deal completion, and equally, can they resolve the tax consequences of that deal? From a fundamental perspective, the company is doing a lot of good things. It's one of the few that's actually winning flow. Performance has been good. The main issue they have in their asset base is JO Hambro, which is their UK fund manager. But the rest of the business is doing well. The new management team we met recently, they've got some clear plans around costs and opportunities around that. So we think from a fundamental perspective, they're doing really well. Perversely, we wouldn't mind the deal not completing, because I think if they could leverage that Perpetual brand, there's potential takeovers that they could participate within. So we think it's decently positioned. We have a very, very small holding in that, just a foothold, so to speak. So we don't mind it, but there's a lot of water to pass under the bridge. And New Hope, simply, you take your view on thermal coal with that one versus met coal. Our preference right here, right now, is met coal. And we prefer Whitehaven. We think there's a lot of opportunity in the Whitehaven portfolio to potentially get hold of more BHP assets. But we think New Hope, it's a pretty safe place. You're going to get your yield out of it. But our preference is Whitehaven.
Thank you. And then Tony's also asked for the best defence stocks and which stocks are most vulnerable to a takeover.
Takeover, I think if I frame takeover first, I think there's going to be a lot of M&A in this market. With the divergence of valuations in the market, with the haves and the have-nots, if we can characterise it like that, a lot of the haves are going to use their expensive scrip to make acquisitions. And we think that will ramp up very much so in the first and second quarters of next year. Companies like a Seven Group or a Wesfarmers, they've got some very valuable scrip right now, which could be utilised to acquire things, which will be highly accretive for their shareholders. So we think those companies will be more on the acquisitive path. The names that we think potentially are vulnerable, some of these held back industrials, which are high quality, like a Reliance, even a Spark for parts of its portfolio. And maybe a Mineral Resources. We've already seen a propensity for Gina to buy the oil and gas business. The assets undeniably are very good within that business, so potentially it's a takeover target as well. And that's the means to an end for Chris Ellison there. And from a defensive characteristic stocks, I think we've mentioned those. It's the Coles, it's the Telstras, it's the Sparks. They're the names that we're really attracted to.
Thanks, John. We have a question from Doug. He's asked, do you believe that WAM Leaders is underweight technology stocks? And have you considered Technology One, which has the ASX code TNE?
Thanks, Doug. We actually, we had a glimpse of the questions earlier, some of these questions, and we are actually overweight the technology space, very selective. And if you look beyond that top 20, where you kind of see those big overweights, we have a lot of incubator positions, what we call in the tech space. We use the volatility in WiseTech to go overweight in that name. In reference to Technology One, we did buy it. We bought it around $14, and we thought we were quite clever in selling it at 20, and it's just kept on going. So it's a great business, but I think the valuation is a bit too stretched for us. We think there's other pockets within the technology space, like Square or Block, like a WiseTech, which we think have more internal inertia to drive more growth. So we are overweight technology in a smaller way, but TNE just doesn't fit in that bucket for us right now.
We have a question from Alan. Why did you take an underweight position in BHP compared to an overweight position in Rio? And what consideration is given to investing in a company with a moat rating versus no moat?
BHP and Rio, it's a good question. We often switch between the two. So you might get a glimpse at an NTA where we're overweight, underweight a BHP or Rio. And the reason why recently we were overweight Rio predominantly was around fundamental positioning on aluminium and alumina. We are much more positive on those names, and we really wanted the exposure through Rio Tinto. And then on the flip side is from a BHP point of view, they are available to or have the option to make a takeover on Anglo again. So we're a little bit concerned that they would come back. We like both companies, but with the banks and with the miners, we often switch between the two or the four at different points of the time throughout the year. So at the moment, BHP and Rio are about even, like our weightings in the portfolio now, because that last Friday was the time when BHP could come back for Anglo, and they haven't. And I did catch up with Anglo this week, actually, and I think they've done enough to defend themselves from a takeover, and I don't think BHP will pay what they need to pay to make it happen. So I think it's a low probability, famous last words, that Anglo and BHP get together. So for us now, it's much more even. So now we're holding equal weights between Rio and BHP. And again, every day we're looking for opportunities. If we get new information, then we'll adjust our portfolio weighting. So at the moment, they're just about even.
The next question comes from John. Will your view on banks be altered if Trump reduces bank regulation in the US, as he's threatening to do following Biden's heavier bank capital regulation?
I mean, it's very much a US-specific regulation change. It will have no impact. I mean, the only impact it possibly could have is if all the world walked away from the bail global regulations, like, because if US don't go down that path, will the rest of the world walk away? Potentially, but it's a very low probability. I mean, for the Aussie banks, very different scenario. APRA have a framework in place, unlikely to change. Very, very low probability of that happening, or very low probability of going to a looser regulations on the Australian banks at this point in time. But like maybe from a Macquarie point of view, there's some potential for, and the only way it will benefit is from increased capital flows and deal flows and opportunities. So it might be beneficial for Macquarie in a sort of a second derivative way, rather than they'll benefit from the environment it creates rather than the actual the framework. So it could be beneficial for Macquarie, but definitely very to no impact for Aussie banks.
Thanks. And we have a question from Peter for Geoff. Why is the WAM leader share price 10% lower than last year when AFIC is the same despite being 11% below NTA?
Yeah, look, thanks, Peter. And this, I know there's another question that came in from another question I was glancing at before the meeting, and this might answer both. And the other question was about the fact that we created the WAM Leaders Trust. Has that had an impact on the NTAs? When we announced we were going to create the WAM Leaders Trust, and why did we do that? Because we had some, like probably one of the questions of the gentleman earlier, we had some actually financial planners that wanted us to manage some money, but didn't want to have to work out if it's trading at a premium or discount NTA, et cetera, et cetera. So we created the trust. Yeah, it's a small pool of capital. And it's managed identical to WAM Leaders. But when we went on the roadshow to talk about that, we're trading about a 4% premium, the interesting thing is, pretty much all the people that are invested in the listed investment company are there because they prefer listed investment companies for their dividend stream, et cetera, and the various other reasons. So when we were doing that roadshow, we actually went from a 4% premium, and this is a year and a bit ago. Went from a 4% premium to a 10% premium because we're going around speaking to people, and and telling them what we're doing, instead of them saying, hey, look, we want to sell WAM Leaders and put it into the trust, they're actually buying more WAM Leaders. And to me, that's one of the reasons I think why in a very short period of time, we rallied to that 10% premium about a year ago. So that talks about the trust part. And then what was the other part of the question was?
Compared to AFIC, So
just
why?
with Peter's, I mean, in terms of where WAM leaders compared to African and Argo. Now, WAM leaders, is an active managed portfolio, very active managed portfolio. I think the guys turn over the portfolio 3 or 4 times a year. That's the whole portfolio. So, trying to make every dollar they can wherever they can. So it's very active. Over the last 5 years has had some exceptional outperformance years. The last year or two has been a lot more challenging. And I think one of the reasons it's gone to a discount is there was one shareholder that had a very large shareholder that purchased, had a property purchase and had been selling. I think that's been put a bit of pressure on us short term, Peter. With WAM leaders, I think being able to deliver over time performance better than the AFICs and the Argos, and also to provide a fully franked dividend that's higher than the AFICs and the Argos, that you'll see, even though at the moment our discounts may be similar, that you'll see WAM leaders go back to NTA, if not a premium. So to me, it's, I take your point. I don't think it's only a short-term situation, not a long-term situation.
We have a follow-on question from Daniel on that. He says, it seems the launch of the unlisted fund killed the premium to NTA in the WAM leaders share price. Am I correct to assume that having a listed or unlisted fund will reduce the likelihood of WAM leaders trading at a premium again?
Yeah, no, and that's not the case at all. When we announced that we were doing WAM leaders, we're at a 4% premium. We actually went to a 10% premium over the following 2 or 3 months. And there's been, people haven't been selling leaders to go into the trust. And you've seen that with other players in the market. Say Plato has a listed and an unlisted trust. A listed entity and an unlisted trust. You can get in and out of the listed trust at NTA, and the listed one trades at a premium. So there's no correlation between that. It tends to be a different group of investors, that want that type of product.
Another question for you, Geoff, from Steve. Why can't you highlight each of your LICs performance net of fees without reinvestment of dividends, but including franking credits, to allow direct comparisons with other investments that I hold that provide this information?
Yeah, that's all possible. Yeah, we can give you any of it. The tough thing is, it's how everyone slices and dices the information. A listed investment company is investing in a number of companies. It's a fund manager, and as distinct from a trust where there's no tax paid, a listed investment company pays 30% tax. So I know you're saying, can we adjust for the tax, take out the management fees and performance fees and any other costs, and then gross up the dividend so you can work out your performance? We can do that for you. To me, there's a whole lot of different measures. We've been talking to the ASX about trying to get a more consistent measure for all listed investment companies, because you've got to remember, if you're investing in an ETF, they don't pay tax. So in theory, your performance is going to be the profit it makes each year. In listed investment companies, 30% tax has been taken out. So it's very hard to do apples with apples. What we try to do on a 6-monthly basis is, in our full year and half yearly result, we give you the gross performance. That's before all fees, so you can see how we're performing versus the market, because there's no fees on the market. And you can make it, we've got a 1% management fee and a 20% performance fee. And the performance fee has to be, it's only when we outperform the market, and that's with a high watermark. So you know what the fee structure is. So we do that. We do the total shareholder return, and we do the NTA performance over a 6-month period.
Thanks, Geoff. And the next question comes from Peter, and it's for Matt and John. It is, what is the 2025 plan to generate investment returns?
Great question. That's what we do every day. We're working out where to position the portfolio, and I think we touched on it. Where I think in the first quarter it's really going to be around the defensive characteristics, and then looking to deploy into the more cyclical components maybe towards the middle of the year. And I think I'll speak for both of us. There's a huge amount of latent potential in a lot of the names we have in the portfolio currently. So it's not like we have to search for them. We've actually got them ready to go. So, and then it's really around positioning and around, like I said, with the China stimulus, we'll probably be sellers of the optimism and buyers of the pessimism as that trade happens probably about 10 times throughout next year, because that's generally how the stimulus works. Everyone gets excited about the opportunity, and then reality comes and misses expectations. Then the market sells off, and then we buy when it gets too pessimistic, and then the expectations start building up again. And that's very much how China trades. So we think that's going to be a clear thematic we can trade throughout the year. And the latent potential in the current holdings, we've identified those opportunities already, arguably a little bit early, but when we look at the investment case, they remain very, very solid and actually improving every day as we speak. So I think the unloved stocks is really where you got to hunt in 2025, but also be cognizant of a little bit of momentum will continue.
Thanks, Matt. And we've got a question from Gordon. With the market already pricing in the current underperformance, what is your forward-looking strategy to regain investor confidence and create sustainable alpha? What actions have been taken to reposition the portfolio? And lastly, how do you plan to communicate tangible progress to shareholders to avoid further erosion of trust?
Can I start on that?
Sure.
As when I'm sure who asked the question? Sorry, that was from
Gordon. From Gordon.
Yeah, from Gordon. Yeah, I'm sure. With yourself, when you're managing your pool of capital, you have periods where you can see things. Well, as I know a futures trader I knew well or know well, he used to say sometimes you can see things in 3D. Where you're incredibly confident on the investments you're making in the market, and sometimes you're less confident. And there are periods, and we'll announce this to the ASX, just the last 5 years' performance, looking at each year. And there was, I remember, go back 4 or 5 years ago when Matt and Johnny, I think when they outperformed the market by 10%. Now, when you're focusing on the top 200, to outperform the market by 10% is exceptional. And to me, the probability of them doing that again, I thought was very, very low. Then the next year, I think it was by more than that, and the third year was by about that. So to me, and then there's just a little bit of mean reversion. The guys have been a bit too conservative. They've talked about they had a position, one position that hasn't worked for them, and that's cost them X percent. And there's been lessons learned, and that's how we all evolve. So, to me, I don't necessarily think the market is having a view on the relative performance. I'm sure, because if you go back 12 months ago, the performance, and we're trading at a 10% premium. I mean, the performance for the little period before that hadn't been anywhere near as strong as the period 3 years ago, 2 years ago, 3 years ago, and 4 years ago. So that's just a little caveat on there. Like, what are the drivers for listed investment companies? It's supply demand, and I'm sure some people have decided, oh well, look, I'm going to move on. But that just creates an opportunity for another group of people that are buying at a discount. But that was just a preface at the start. I'll pass it over to Matt and Johnny to go through the rest.
Gordon, we appreciate and can recognise your concerns, but for us, if you look at our track record on a 3, 5, 7, 8 year basis, we think it holds up against everyone else. And absolutely, we made some bad choices in the last 12 months, but we haven't changed what we do. We've taken the lessons of the last 12 months and we've implemented them in the portfolio. Our process, we believe, is proven. And as Matt said, we've got a lot of latent potential within the portfolio, and hopefully over the next 3 to 6 months, as we start to generate those returns that we're optimistic that we will generate, we can prove it to yourselves and the rest of the shareholder base that the process is still solid and sound, and we don't need to go and change everything. So for us, we're happy, we're content, we've recognised the mistakes over the last year, and we're moving forward.
And what are the lessons, Johnny? I just on that. What are the lessons?
For us,
how have you modified things?
Yeah, so I think firstly around recognising the market cycle that we're in, we probably went too contrarian, too conservative around valuation and being so steadfast in looking at the valuation, particularly in the banking sector. When there's a thematic out there around the rate cutting environment, valuation sensitivities were out the window. So people just bought momentum. And we probably should have participated in that a little bit longer. So we've made some adjustments in the portfolio to keep up, not to replicate, but to keep up. And then around stock selection, Star positioning, our size was too big for the risk that it demonstrated. Government risk and the reach of government around earnings, that's something we definitely learned the lesson of very quickly, and it's helped our valuation and our focus around stocks like Endeavour and Woolworths and the like. And I guess Star was one of the things where I think we said in the September call there was probably a little bias from the success that we had with Crown and the returns that we generated from our Crown position. So I think we needed to take a step back, evaluate the risks to earnings. We did misinterpret the risks to the earnings that was coming from the regulation that they faced and just the sheer level of complexity and issues that the company faced. And look, may as well deal with a couple of the questions that we've had on Star right now. We've managed that size down the portfolio. We've taken the pain. Right now, we see it as option value in the portfolio. It won't hurt us too much. And if something were to come to fruition, we would recoup some of those losses, but not all. We've accepted that we've taken that hit. There are a number of challenges the company continues to face. And I think at the AGM, Steve McCann acknowledged that it's not going to be a quick journey. I think we said the same thing back in September. This is a multi-year turnaround for a corporation that had significant issues. But what we do know today is it's probably got the most robust and sound compliance regime of all corporations in Australia. It's gone through that much change, and it's still going to go through a hell of a lot more change. But that doesn't mean the earnings are going to rebound anytime soon. So from that, we've had to accept it, move on from it, and now our focus is recouping those losses in another way.
Thanks. I'll just ask a handful of questions related to Star now then, just to cover them off. Have we removed ourselves from Star? I think you mentioned it's around 1% of the portfolio.
Just conscious there's always journalists on this call, and last time we got picked up, I think with Star, we've managed that position down to a sub 1% holding now within the portfolio. So I think we'll leave it at that.
Noted. Thanks. Okay, so now the next question comes from Bob, and this is for Geoff. The decision to remove the current top 20 holdings is a major concern. Can management add this back to the monthly report? Every liquid ETF I hold, except WAM Leaders, publishes at least their top 20 holdings, and now most ETFs publish what they hold at least monthly.
That's probably more for Matt and Johnny.
Well, I don't think it matters from our perspective whether we publish the top 20. So we're open to the idea if we want to have a discussion internally. I think from memory, the thought process was to do underweight, the top 5 underweight and overweight, to give a more perspective around the active positions in the portfolio. But I'm not I don't mind if we go to a top 20. I mean, we can table that 100%. If
You'll find that in today's presentation that the top 20 holdings are included, and equally the top 5 overweights and top 5 underweights. And look, if we've made a mistake in not including it, we'll absolutely address it and we'll deal with it internally.
Yeah, I think it might have been when we were putting together the new structure for the NTAs. But hey, look, thanks for the feedback. Yeah, we'll look at it. Yep.
And the next question comes from Roger. LICs that I own pay quarterly dividends, are less volatile and trade closer to their NTA than those that pay dividends half yearly. Would you consider quarterly dividends? Perhaps that's for you, Geoff.
Yeah, I mean, look, that's a question for the board. Yeah, pretty much half the LICs, or they call listed investment trusts in the UK, do quarterly dividends. Yeah, it's been a trend that we've been aware of for a long time. We haven't done that here. I'd be interested to know which LICs that he's referring to, because I've seen no correlation between moving from half yearly to quarterly dividends and the reduction of NTA discount or the premium to NTA. And just on that, we actually are potentially, there's a few things happening, and there's been a bit of demand, and we're looking at potentially a new structure which would have more frequent dividend payments, not in the WAM leader structure, but in a totally different structure. But that'll become, we'll keep you all informed on that.
Thanks, Geoff. The next question comes from Ken. I've been in the market since 1963, and it appears to me the market is overheated. If the market did correct, would WAM leaders come back to shareholders with a cash raising? Matt and John?
Yeah, that's a cash raising would be one for the board. Are we? Yeah, I mean, we agree with the market is overheated, like 100% it's overheated. I think I touched on this in the when you look at percentiles, it's off the charts heated. The equity risk premium, which is another thing we look at to judge the market cycle, is effectively zero. So you're not being compensated for extra risk. So yeah, 100% it's overheated. What will trigger that to change? And again, I'll point to January. We think that's a likely possibility. Again, it's not a 100% probability that it will disrupt this, but we'd put it as a high probability. And for the cash raising, I mean, that's up to the board. And I don't think we'd ever.
And probably, like, if the market adjusted, it's probably not the right, even though it might be the right time from an investment perspective to raise the capital, it's probably not the right time for shareholders, to raise the capital, because usually, we see, since 63, you've seen the early 70s, you've seen, the 87, you've seen the Asian crisis, you've seen them all. And even though it's the logical time to put more money to work in those periods, that unfortunately the bulk of the investors are running for the door.
And Cam and Peter have asked, how would you describe the performance over the past 2 years, and what have been the main lessons learned over that period?
Well, I think John touched on that before on the previous questions, but I mean the main learnings, I guess, when we just go back to position size and risk management, and making sure. I go back to quality of management too. I think we missed that on the on learnings from start. But you got to have the right management in place to get you through tough times, and like it's just a good reminder to go back to the real. Getting under the hood and making sure you're ticking all those boxes again, because, management is crucial, as they are, agents for our money, your money, and they've got large workforces they have to motivate and guide through regulatory issues. So you need the right people in place. And I guess that was very specific learning from a stock. From a market perspective, I mean, the momentum in the market, like we positioned for a lot of stocks which were deeply undervalued, and we thought when interest rates would fall, they would come up. But what happened was the market went to the first derivative, which is discount rates fell, and then momentum stocks went up, and long duration stocks went up, and the deep value got left behind. So it's a little bit of a tilt. But again, that's in the wisdom of hindsight, you can call that. But the ingredients did really marry up for that trade to work, and it just didn't work. We found money was very much targeted towards anything with earnings momentum, and also the long duration trades just took off, despite interest rate cuts being priced into the market. When they actually came to reality, the stocks took on another level, which was again quite surprising to us. So I think it was a combination of the market was very uncertain around how the cycle was progressing, so it got really crowded in a few names. So I guess in hindsight, we probably should have looked through what the market was interpreting, and they didn't have enough confidence to deploy money into these stocks. They just crowded. And once we saw that trend and knew it was sustainable, probably should have followed that trend for a bit longer. We did get into that trend and managed to keep up with the market for a period of time. They're the biggest learnings in addition, because John's already covered that off, but just a few additional.
Thanks. And the next question comes from George and Paul. In a recent video, WAM Leaders was positive on Spark New Zealand. This was after a first earnings downgrade, but soon after Spark issued a second earnings downgrade. Do you still believe this is a short-term issue due to the current subdued outlook for New Zealand economy and consumer spending, or is it a more serious issue given the company is losing market share in New Zealand? And are you still positive?
George, great question. I think you've nailed a few of the main points there. And for us, we had a small position at the first downgrade, and we've increased that since, because fundamentally we believe that the assets that this company own are materially undervalued, and we've done some significant research, and we think at the valuation where it is and the economic cycle where it is in New Zealand, they being a year ahead of where we are, we'll start to realise a return to normality, and Spark should kind of rebase from where it is. It's had a confluence of issues, including the removal from the MSCI index, which led to some 10% of the company being sold in late November. And that, again, provided us an opportunity to get fully positioned where we are now today. One of the things that we do expect Spark to do is to divest a number of their non-core assets. And today was a prime example of them being able to do that by getting rid of their towers business and realising some $300 million plus for the remaining part of that portfolio, well ahead of where the market expectations were. We think it's an asset-rich business. It has data centres. It has subsea cables. It's the number one telco provider in New Zealand. The New Zealand government spending is absolutely an issue. But we think that is a temporary phenomena, just part of a normal market cycle, and it's been sold off from a confluence of things being flow and the downgrades. And we think if they go down the path of asset sales, which they're embarking upon now, the value in this company will be quickly realised. And our entry price isn't far north of where the share price is today, and we think we can certainly get material upside from where it is.
And probably the big one as well is around the dividend. It was really bought as a dividend stock, and then people got scared that they couldn't maintain their dividend. This asset sale demonstrates they can actually divest. But there's also on the bottom of the announcement today about a capital partner process for their data centres, which is why there's been a little pressure on the stock too, because people think this data centre is going to cost a lot of money to fund. They got the dividends at risk. So we think once they announce the capital partner, it'll be a real clear catalyst for this stock to re-rate. And if you pull up the chart, you can see the potential of this stock. But the market share is a very interesting one too. You're 100% right there. It's got more competitive. But we think the size of this business and the New Zealand economy has been so rough, and it's been hit by the downgrades have been predominantly from the government enterprise part of the business. So they've identified this, and they're pulling out $120 million of costs to offset this. So, from our perspective, I think a lot of the damage has been done. Competition's always competitive. It's probably got a little bit more competitive, but we think there's a significant upside just to return back to historical valuations on this name.
The next question comes from Chris, who's asked, if China deliberately devalues its currency to accommodate US tariffs, what will be the effect on our market, especially BHP?
Yeah, I mean, that's what they did last time, actually. It's a good point. They effectively let the currency devalue by the quantum of the tariffs. So, I mean, it's largely expected to happen again, but probably not in the same quantum. We think more domestic focused stimulus. I mean, I was up in China a couple of weeks ago, and that was the consensus that once Trump got in, if he got in, then tariffs would be implemented, and then they would do more domestic focused stimulus to prop up the economy. So from a BHP perspective, again, iron ore is probably not the greatest trade because it looks like 2025 there'll be a little bit of an oversupply in the iron ore market again. The steel market's been running pretty solid in China, and there might be some export issues given there's some anti-dumping measures in place on China exports. So iron ore is going to be tough because it's not really going to be – they're not going to stoke the property market up again in any great manner because there's still about 3 to 4 years of inventory out there. But the expectation is the property market will start at bottom in the end of 25. There is potential for some shantytown redevelopments like in the Tier 3, Tier 4. So although we said iron ore oversupply, there is a path where there could be some property investment through shantytown developments, which would be positive for BHP. But net, I think the domestic focused stimulus would be more positive than the currency impacts for the BHP.
On China, Simon has asked if there is to be more trade war concerns in 2025, do you see that leading to higher or lower gold and crypto-like assets?
Oh, that's a tough question. It's not. Yeah, it'd be really. You'd have to take a view on a whole lot of other aspects which aren't totally related to gold and Bitcoin. So for Bitcoin, I mean, Bitcoin's just rallied because Trump's embraced it and said there's going to be, a czar of cryptocurrency. So all of a sudden, Bitcoin's gone on a speculative run. Normally, Bitcoin and gold go on a run if there is excess US dollars being printed, like through, fiscal deficits or if there's negative real rates. So you need that environment to get really positive on gold or Bitcoin. So just look for anything that will impact those two factors.
Well, the other comment around the strength of the US dollar from Matt earlier, that typically correlates with a weaker gold price. And then equally, if Elon Musk and the Department of Government Efficiency come through, we might see some fiscal discipline coming through in the US. So, there's a lot of factors to go into it. So, it's something we're trying to work out ourselves.
Well, yeah, if Elon comes in and takes out $2 trillion, that's very negative gold. So that's something to watch as well.
Well, just a little bit of feedback about that. I caught up with a very senior executive, a US senior executive, who's chair of two large companies in the US about a few weeks ago, and he was saying the probability of Elon being able to take those costs out. He said if he can keep them neutral, not increasing, he's done an exceptional job. He thought it's highly, highly improbable.
Yeah, that's the feedback I got as well, Geoff, with Scott Besson. He thinks those the 3% deficit, 3% GDP growth and 3 million of extra oil is highly unlikely as well. So, but I think they've been emboldened by Argentina. The presidency's done there, like he's gone back to surplus, which is I think you'll start to see that. But there's a great we could share the link with I think it was a podcast with Elon talking about what he could do. It's actually a really good listen to. If anyone wants to listen to it, you can find that, or we could post it up later. But yeah, you're right. I mean, it seems astronomical, like $2 trillion. Yeah, I know they said drain the swamp, but I'm not sure the swamp's got $2 trillion in it to drain.
A few more portfolio questions. Peter asks, why is the portfolio underweight CSL?
Yeah, thanks, Pete. That's probably the one stock that faces some headwinds under Trump. The dependence on migration from Mexico and collection. We had some sort of concern around their ability to procure product, in lack of other crude terms, and equally around the appointment of Robert Kennedy Jr. Just some minor concerns around the growth of the vaccine business, which is one of the pillars of CSL. So there were probably some what we call flesh wounds that were going to impact CSL. Currency is a little bit of a headwind. So around that $300 mark, we decided to go underweight. We've closed some of that underweight out now at in the 270s. The market does have a fair bit of growth coming through over the next couple of years in the mid-teens. We think maybe that's a bit optimistic, and we think potentially more saleable and sustainable growth rates around that 8 to 10%. But it's something we're absolutely doing a lot of work, and as it falls, it's we'll pick up some more stock here, but it's just that confluence of issues that we just pointed out that makes us a little bit concerned.
Yeah, I guess the point is if Bobby Kennedy Jr. doesn't get passed or nominated or into the Senate, then we'd actually might flip back to be more positive. But I think Trump last time he was really hard on drug pricing, and now CSL was largely immune to that. And but now they have the V4 business, which is going to have more exposure to potential drug price hits. So it just makes us we just became a little bit more cautious, and we just got to walk through the risk now.
And a lot of what I point out may not actually come to fruition, but the sentiment had turned. And again, lessons of the last year is don't fight the sentiment until you need to.
The next question comes from Bill on South 32. He says, I note that you're overweight South 32. How do you evaluate the risk with its large Mozambique operation, given huge government impost on an Australian miner to do business in West Africa?
I'll answer this quickly, and then Matt can give you the detail. But Matt's currently tracking port movements in the port of Mozambique to see activity measures over there. So it's something that's on our screens every single day. Just from the size of that asset, it's around about 4 to 5% of revenues. It doesn't generate a lot of profit. It's about a $1.2 billion asset value, which is relatively small in the overall context of South 32, but Matt can talk about a few more thematics.
Yeah, so very good question. And like John was saying, we've been monitoring port activity. The issue is they can't get alumina from the port to the smelter. So it's about a 15-kilometre stretch. So it's not far, but given the protests since the election, I think the election was in October, from memory, but it's been challenged, and the person that lost the election has called for these riots to happen, well, not riots, but protests. So the international community is looking into it now, like obviously more focus. South 32 asking for government assistance to, have a convoy of trucks to be escorted to the smelter, because it's about 2,500 jobs there. So it's a big part of the local economy.
It's more important to Mozambique than it is to South 32.
Yeah, but on the flip side, South 32 can sell the alumina that would normally go to Mozambique into the spot market and get a higher price for it. So they can actually offset a lot of this. They've got about 10 to 14 days of inventory of alumina. So I don't know where they sit now. Maybe it's 6 to 8 days. So they've got a little bit of a buffer. The real damage will happen if they have to move the smelter to care and maintenance, and that's when you start to get all issues, because these things are really hard to turn off and really costly to turn back on. So we're watching that very closely. We'll be continuing to watch the port movements to make sure that ships are actually getting there, and we are hoping for some more clarity around the situation. But worst case scenario, it might cost $200 million to ramp it back up. That's absolute worst case, and the market cap's already moved by more than that. But for South 32, also we'll probably get a Worsley decision from the WA government before the end of the year, which will be incredibly positive if it goes in their favour. So it's an overweight. We are watching it. didn't think it would end up like this, having because it's only 15 kilometres from port to the smelter. We thought that you'd pretty well have safe passage at all times, but it's really escalated. It's quite a sad situation in Mozambique. There's been a couple hundred people killed in the protests, and we hope for everyone's sake it gets sorted out quickly.
The next question comes from Michael, and it's on the bank sector. The Big Four have closed down many branches recently to save costs. What's your opinion as to how the banks can grow their business? And could you also please comment about the banking dividends going forward?
Yeah, I mean, for the banks, it's an incredibly competitive market. The bank net interest margins, which is a driver of earnings, have been deteriorating quite fast. So it's and they have been closing branches, but quite ironically, we were talking to Westpac about closing branches, and they actually might start increasing the branch count. So they've almost come full circle where they've probably gone too far. But from a banking perspective, incredibly competitive market, writing loans at cost of capital, which means effectively you're not really generating returns to add to your book value. So for us, it's just a really, really tough sector. To get positive on it, you'd almost want an interest rate hiking cycle. That's when you can really get net interest margin expansion. But we're probably going to go the other way too, which is why this setup is incredible, because next year, we had a strong jobs report today, so maybe the cuts are maybe pushed out a bit, but next year looks really bad because you've got potential for interest rate cuts and net interest margins to decline if the competition just stays where it is. So it's very intense. On the dividends are very safe. They've got excess capital. They've been doing buybacks. They still have excess capital. The only potential is if we went into a bad credit cycle, which is highly unlikely. And the credit cycles for banks are a lot different than the early 90s, where banks normally go under from commercial loans. They've hardly got any commercial loans, so big residential mortgage books now. So the likelihood of dividends being cut or effectively stopped is highly unlikely. But the excess capital puts them in a great position to keep paying dividends. So banking sector is very healthy, but extremely competitive, and net interest margins are really, really low. So it's not a great sector for us from a fundamental point of view to be invested in a meaningful manner.
The next question comes from Usman, who's asked, do you see more capital flowing towards REITs post the phase out of the bank hybrids?
Not at the moment. The driver of REITs at the moment, we can see it like even today when you had the strong jobs report come out and then our short-term rates went up, the REITs got sold. So I'd say discount rates and short-term rates are the main driver of REITs at the moment, but we haven't started to see, maybe next year when the redemptions start coming in for the hybrids, you might start to get a flow. But we think, again, go back to the WAM leaders' share price and LICs, we think the removal of hybrids is going to be an incredible opportunity for listed investment companies that pay fully franked yields. I mean, that's why we think this is an anomaly with discounts. We think the attractiveness of LICs is going to go up over the next period as hybrids are removed, and yields will probably be a beneficiary of this as well, the REIT sector. So for us, we're not seeing it yet, but we would expect it to happen over a period as well.
And just backing up what Matt said is, and we've sort of tried to be as vocal as we could, put submissions into APRA, when they were asking for them. Unfortunately, they still came out last week and confirmed they were going to get rid of the hybrids. We still think it's illogical and it's negative for the Australian capital formation, of the Australian markets, and also for investors. As Matt said, is obviously people will be looking for fully franked yield, and listed investment companies will be a beneficiary. And you've got $22 billion over the next few years looking for a home. I mean, we also will be next year. We'll be creating. I alluded to it a little earlier, a more of an income product, which will be paying monthly income, which will fit into that space. So, we'll keep you fully informed on that.
Thanks, Geoff. And a few questions for Geoff regarding takeovers. Did taking over other LICs using WAM Leaders Premium and Profits Reserve as a hook to new investors contribute to the NTA decline? And has WAM Leaders taken over?
Let's just do one at a time. Then we get them answered. If you ask me 10, then you get 3 of them answered. So the answer is no. We didn't use WAM Leaders Profit Reserve. When we bid, if it's WAM's traded at a premium, then obviously the ratio works in our favour. If you look at the last one we did, QV Equities, I think it added, one of the secondary benefits was picking up the franking, and it added, I think, a year and a half, or it allowed us to pay enough franking for those additional shareholders for a year and a half. If you look at the announcement, it's in there. It was one and a bit cents of franking we picked up. So that's that part. So that hasn't had a negative impact. And if anything, there's been the secondary benefits of picking up the franking. What was the second part of the question?
The next question was, has WAM Leaders taken over anything that has resulted in the issue of further shares?
Well, each time, WAM Leaders made a takeover, and all WAM Leaders takeovers have been reasonably small. Then we tend to give them a cash alternate or a share alternate, and it tends to be we've issued shares when we've taken them over.
Thank you. And we have a question from Nicholas. He asked, what are your thoughts on allowing the fund manager more flexibility and instead of returning capital to shareholders, instead reinvest some of the retained profits reserve to try and grow the asset base again and help to close the discount to NTA?
Yeah, and you'll see when we announce the slides, just how much we paid out in terms of dividends. Now, why we paid those dividends, it's because we've had franking. Franking's a lot better in your hands than in the company's hands. The profit reserve is an accounting thing, number that allows, it sort of gives you some comfort that there's profit that can be paid out. To have those profits fully franked, then we've got to either pay tax or receive fully franked dividends. So to me, it's the Warren Buffett philosophy of never paying a dividend is because they've got a different tax regime in the US. Our tax regime here encourages us to companies that have paid tax and have fully franked dividends to return them to investors, because they can get a benefit by getting money back from the tax office.
On this topic, Rob said he would like to see an increase in the NTA, but it seems that the dividend policy is paying out too much. By retaining more earnings, the NTA will increase and future dividends will increase. What are your thoughts on this?
And he's 100% correct. But you can do that yourself. What we're doing is we think we're doing the best thing for shareholders, because the tax we've paid, we're better off paying it out to you as a fully franked dividend. We could have not paid a dividend. Unfortunately, we still would have had to pay the tax if we've had trading profits, and then the share price or the NTA would be 40 or 50 cents higher. That's not including the tax we paid, which allows you to frank it up. So to me, what you've got to do is you've got to understand that. What you may do, if you just want the capital growth, not the income, then you just go into the dividend reinvestment plan. So you get more shares. Obviously, there's tax paid, which allows us to pay the fully franked dividend out to you. But the reason that tax has been paid, and it's paid because we've made a trading profit. What you've got to look at is, as an investor, your returns, and I mentioned earlier, like at the moment, you're getting a 7% after-tax return. That's more than 10%. So the portfolio we charge a 1% management fee and a 20% performance fee. That's of outperformance. Now, so forget the performance fee. So we've got to do 11.2% per annum to break even. Now, historically, the guys have done, have outperformed by more than that. So, pretty much the size of the dividend we're paying is the bulk of your return. Because if over time we do 11 or 12% per annum, you're getting it mainly as a fully franked dividend.
A few more questions on dividends. One from Garth. Why don't you pay your dividends earlier by, say, 4 to 6 weeks?
Yeah, we could, but I mean, the classic example is most of the people on the call probably watch the market closely, and you would have seen Platinum, the fund manager, come out with a few days ago and announce paying a special fully franked dividend. To me, it was perplexing why they paid that dividend very quickly. The reason I say that is, if what you tend to find, and I mentioned earlier in the call that one of the reasons I'm buying at the moment is because we've gone ex-dividend, and so therefore you tend to find when you come dividend, and if you come dividend for 2 or 3 days, or you come dividend for 2 or 3 months, you tend to find people buyers into that come dividend period. So to me, if I had a choice, I would like the shares to become dividend all year round. But the board is of the view that keep it come dividend for a period of time, and then pay it around the same time that we pay it each year. And what you tend to find is you get outperformance during the come dividend period, and on the ex-dividend period you get underperformance, and that's just people looking for franking, and that's how the market works.
We've also had a few questions on what the outlook is for dividends in 2025.
Yeah, well, we've got the profit reserve, so secure. I suppose obviously the board's got to make up their mind up. Already there's that's a very high dividend payment. So if the dividend was increased, it would be very gently increased or maintained. The plan is to give one of the great things about listed investment companies, which you don't get about with ETFs, is you can pay dividends to investors over time. So very, very powerful for self-managed super funds. I mean, 65% of our shareholders, this is the 130,000 shareholders we've got between the 8 listed investment companies that we manage on behalf of shareholders. 65% we estimate are self-managed super funds.
Thanks, Geoff. And we've got a few more stock-specific questions for Matt and John. From Gregory, what is your view on the prospects for annuity provider Challenger over the next 12 months?
Good question there. Challenger have been in an upgrade cycle for the past 3 results. You'd probably see the share price, it's gone the other way, predominantly due to Apollo selling out of Challenger. So the share price will tell you that it's not doing well, but it's actually doing incredibly well. So what's the prospects? We think it's got great prospects, and why it has is because APRA are pushing super funds and the broader Australian financial markets to have more annuities on offer, and going back to hybrids as well coming out of it as an option. We think Challenger is well positioned to fill that hole, and we're starting to see traction now. They've done some big deals with super funds already, and we think they're in a great position. They've increased the quality of their book. They're cost out at the moment through, I think it's Accenture are doing it for them, a multi-year journey of I think it's around $150 million of costs coming out of the business and efficiency. So we think, upgrade cycle, costs coming out, and the backdrop is huge tailwinds for the annuity sector. So we think Challenger is well positioned. There's just one more stumbling block is the overhang from Apollo just weighs on the share price. So you're not being rewarded for the great activity Challenger are doing at the moment. So prospects look incredibly good for them.
The next question comes from Andrew. John previously said APA was not attractive due to government regulation. Has that changed with the AER decision on the Queensland pipeline?
Short answer, bingo. You're right on the money there, Andrew. That was the catalyst for us to get back in the stock. We couldn't believe on the day when the announcement was made that the share price was down. So we did take advantage of that. What I will say it's a smaller position than what we would like it to be. We have just some reservation around the company wanting to potentially make more acquisitions. So we're just keeping some of that powder dry just to kind of watch it and see how it plays out.
Yeah, I think in WA, the opportunity in front of them is $2 to $3 billion. So, that they will need capital to take advantage of the clarity around WA government as well and Pilbara. So, John's 100% right. They need capital, and we just don't know how they're going to do it yet.
The next question is from Stephen. Was your investment into TWE too early?
No, we've had positive experience with TWE. We've traded that one okay, and I think our average price is around that $11 mark, and I think it's trading near on $11.75, $11.80 range today. So it's been one of probably it's been a decent returner. No, I wouldn't say it's a stellar returner, but it's been a decent returner. But we think where we are now, the outlook for TWE is particularly robust. And I think the biggest concern that we're facing, and it's similar to the commodity space, is the belief in China and the willingness for the Chinese government to stimulate and equally changing that sentiment of investors that China is going to be a good place or a better place, or should we say, to invest. If you look at what TW has been able to achieve, their US portfolio, in particular Dow, the most recent acquisition, and Frank's Family Vineyards, they've done really, really well. But it's the lower quality, more mass market, cheap price point wines, the more commercial stuff that is struggling, and they're embarking on a divestment program which should see that exited from the portfolio. And what you'll be left with is this premier prestige wine business, which will be highly attractive. And we're of the view, and to one of Tony's questions earlier around M&A, well, we feel if Treasury stays in the $11 mark and they do clean up that portfolio and are primarily focused on the prestige market, they will be an attractive takeover target. We think the presence of Penfolds and the brand Penfolds in China resonates stronger than any other wine label in the world. And what they're doing from a strategic standpoint of going on in market to China and establishing more vineyards there is a tremendous strategy. So from that perspective, we think there'll be some surprises around earnings, positive surprises around earnings in February and August next year. And they'll be extremely well positioned to capitalise on the return of the Chinese consumer when it does eventuate.
Thank you. And then we've also got some questions on two other ASX-listed companies. Do you have a view on Orthocell? The ASX ticker is OCC. And the next company was Ventia Services, which is VNT.
The first one's outside of our investment horizon, but I'll give a plug to the WAM Capital conference call, which is happening next week, and I'm sure your inboxes will be inundated. So perhaps that's a question for Oscar and the team. On Ventia, it's not a stock we've ever owned. Actually, Matt and I were discussing it earlier. It's probably one of the few stocks that has never resided in the portfolio. And given what's happened today, and for those callers that haven't seen the news today, the ACCC has taken action against 3 service providers to the government around collusion and pricing and price manipulation. Ventia, Downer, and Private Supply being the third one. And Ventia's share price is down 20% following the ACCC action. And for us, what that is, it's the first time Ventia's ever come in question around their processes and their diligence and their, let's call it their squeaky cleanness in lieu of a better term, than in the past. So it's been a D rate for it today. These proceedings, the last time we saw something like this happen to BlueScope, and it typically takes 2 to 3 years for them to resolve. The remedies are most likely to be fines and more procedural costs around the processes around contracting. So Ventia has been squeaky clean until now. So what we've seen today is a D rate of the stock. It was probably on a multiple which wasn't justified for the type of business that is, and it's a service provider. We don't own it. We're probably not going to own it. Downer, on the other hand, we're having a closer look because it only represents about 7% of its earnings. Just by luck and chance, we're having a meeting with Downer on Monday, so we'll probably be in a better position to have a view on Downer following that meeting. But they're not typically companies that we're attracted to because there's high turnover, razor-thin margins, and any sort of changes we've seen today typically leads to a lot of negative operating leverage.
Thanks. The next question comes from George. Is there further upside in ResMed given the good run in the last 12 months after the Ozempic panic?
Great question, George. The thing about ResMed, like, they do have operational momentum going for them and margin improvement. So we think there is some upside still left in ResMed from an operational point of view. On the sentiment front, you highlighted a point there. It does get knocked around a bit by, these weight loss drugs, and it has potential for short attacks where shorters come in and they flood the news with, like these weight loss drugs and how they're going to kill the sleep apnea market. So it's something we watch all the time and always have in our back of the mind, but will it ever go on a really, really strong run because of this backdrop? And the problem with the weight loss drugs in a few years' time is when all the patents come off and generics come into the market, the price will come down and you'll have oral tablets dominating as well. So it is a risk, but in the short term, we think momentum is definitely with ResMed. We think they can continue that. We quite like it. We've got a 1% position in the portfolio, and it's got really good earnings momentum with margin upside. So, we like that one at the moment.
The next question comes from Alan. He said earlier that you mentioned that valuations are getting extreme. Can you just give a bit more colour on what this means?
Yeah, I guess from when we talk about extreme valuations, we go back to equity risk premium. Normally, you'd have to have an equity risk premium. It's a theoretical term where you're discounting stock prices and you use it for like a measure of risk, basically. How much are you paying to take on risk and you're not getting compensated for it at the moment, which tells you that's extreme. Like with equities, there's always risk and you're not getting compensated for that risk. So that tells you extreme. And then we look at the PE ratio, so what price for $1 of earnings are you paying? And that is, arguably at extreme levels too when you look at the percentiles we trade. So when we talk about extreme, there are two things we're looking at the moment. Like another way you can do the equity risk premium is you look at the yield on bonds and the earnings yield, which is the inverse of a PE on stocks, and you compare the two, and you're just not getting compensated for taking equity risk, basically. So that's what we mean when that's extreme. Normally, equities are risky. You expect to, be getting a reward for that, but you're not getting it at the moment. So that's what we mean when markets are extreme.
Thanks. The next question comes from Paul, who it's also on this topic. With the banks at such high valuations, would you be wary of holding the ASX 200 index currently?
Yeah, I mean, that is something we think about all the time. Obviously, the major banks for us is roughly 23% of the index. So, it's something we think about all the time. What would change our view is, I think what will happen next year is you're going to have asset allocation decisions made by big super funds and sovereign wealth funds. And given the run we've had in equities and given where interest rates are and, we're potentially on a cutting cycle, I think you'll see a big switch in asset allocation out of international and domestic equities and into fixed interest and alternative assets. So that will drive some selling. So like when we think about the banks at the moment, they're obviously a beneficiary of flows. We think that changes next year where they'll be getting hurt by flows as some equity exposure is taken out of the market. So we think that will reverse in our favour next year.
The next question comes from Stephen, talking about your investment philosophy and strategy. Is it a combination of fundamentals and momentum to initiate a buy or a sell?
I mean, the way we look at the market is we sort of have a framework of three pillars. It's the macro environment. Is the macro environment supportive or like a tailwind, or is that a headwind for the company? Then you've got the fundamentals. You look at the valuation, the company management, their earnings growth, earnings potential. And then you look at positioning, and positioning is sort of a function of valuation. So, and also the direction of flows into the market. So for us, it's a combination of the three things. So, it's just not strictly momentum, but that's the momentum is captured on the flow or the positioning dynamic, which we look at. So we do take it into account, but we'd probably look at more momentum positioning on commodities rather than futures markets. And equities as a whole, you generally look at like commodity traded accounts like CTAs. Are they buying or selling equities? So it's a very complex subject. We can go into great detail, but effectively we do look at momentum through how market participants are positioned and where they're likely to move funds around. So it's a real combination of those factors.
The next question comes from George. Out of all your holdings, which company do you think has the most upside?
That's a great question, George. Well, I've got to go with, for me, the one that's been punished the most. I think Spark has got tremendous upside, like in the very short term. That's probably got the most latent potential because it's had the combination of fundamentals and the flow we were just talking about, momentum. It had the most severe negative momentum through an index exclusion. So for me, that's got the most short-term upside.
For me, I'm more comfortable seeing half a dozen names go up 20%. That's what I prefer to see. But if I had to go out on a limb and pick the one, given our conviction around China stimulus, I think some of the really beaten up commodity names in the lithium space, from a short-term perspective, and I'm assuming George wants a rather shorter term as opposed to a longer term one, I think something like a Pilbara or Mineral Resources could have a quick short-term 30 or 40% in them.
Oh, you got to throw South 32 in there. I almost left out South 32. Mm-hmm. If you get the Worsley and the Mozambique resolution, I mean, that could put on, 15 to 20%, on the announcement. So that's another one.
The next question comes from Jennifer. She asked, are there companies outside but close to joining the 200 that you think will grow during 2025 and that will break into the ASX 200?
Yeah. Part of our process is that we're allowed to take a view, as Jennifer's expressed, that stocks that can get into the top 200. And one that we actually bought a couple of days ago is a Toronto listed, dual listed copper company called Capstone. That's just sitting outside the 200, and we think potentially over the next 3 to 6 months it will certainly be included in the ASX 200. Has the copper tailwinds that potentially come from stimulus. Operationally, they're doing well, so we've put a little position in that one. And then the other one we've recently seen, and I can see there is a question about Digico and Guzman and Gomez. One of the things that we're seeing more and more in markets is the impact of index inclusions, particularly when they get included in the global indices like MSCI or FTSE. Digico is one of those ones that will IPO, and there's been a lot written about the asset quality, and we'll take a step back from that and just talk about the mechanics of the market. What we will find is that we'll likely go straight to the ASX 100, straight for not long after the IPO. The way that it's been allocated, it feels like most institutions and index funds are going to be underweight, so they're going to be very much forced buyers, similar to the way that Guzman and Gomez was done. So, I think, Jennifer, your point around index inclusion is one that is more prevalent than it ever has been before. And it's something that we are engaged in and spending a lot more time trying to focus on, because there is certainly value to be added to the portfolio, not just in index inclusions, but equally index exclusions, as we've seen in Spark. It's given us an opportunity to have a more fulsome position in the portfolio.
Graham's asked for your view on Qantas.
I still remember when we were at, I think last November in the Perth Roadshow, when all the Alan Joyce stuff was taking place, and I think we were asked what was one of our top stock picks, similar to the question George asked a couple of minutes ago, and we said Qantas, and it wasn't well received, let's put it that way. But what they've been able to achieve over the last year is phenomenal. particularly under Vanessa's stewardship. She's done a tremendous job in changing the psyche and the DNA of the company in a fairly short period of time. They've had a lot of tailwinds, primarily being the reduction in costs from the oil price. And that's also led to a number of concerns, primarily being their CapEx program or their spend on new planes, in simple terms, to be pushed to the right. Given the profit they will generate this year, which isn't probably what the government wants to hear, but it's what shareholders are happy to hear, they're going to make a lot more money than the market anticipated. So what we're in a position today is that they're going to be able to pay a dividend, continue down their buybacks, and also afford their fleet renewal. So it's almost this perfect storm that we're seeing in the global airline space, where demand is holding up, costs are coming down, and profitability is unparalleled. All that being said, it's in the price. So we've exited a large proportion of that position. We still hold a small amount, but significantly less than what it was. If it got around that $8, the question we have to ask ourselves is this a material shift in the way that we need to value airlines? Is it a structural shift, or has it just been a cyclical shift? We're probably more of the view that it's been a cyclical shift. But if we get more evidence that it's been a structural shift in the way that we need to value an airline, then perhaps it's worth close to $10 or $11 than the $8 that we're thinking.
Probably worth mentioning Virgin too, like being largely handcuffed. I would have thought like.
Yeah, it's been a cosy duopoly where both parties have been focused on profitability. What does that change under the Qatar partnership? Probably. I think Geoff's pretty happy about the fact that he can fly someone over Qantas internationally now. So it does maybe change the game a little bit, but we'll see what strategies.
I thought you were going to say I'm not in the chairman's club yet. Hey?
I'm not going to say anything like that.
Got to be chairman of a few more companies.
Yeah.
Richard has asked, are you underweight oil and gas? And if yes, why?
Yes, we are underweight, Richard. The reason why, obviously, you see all the industry reports and even the oil energy associations themselves keep downgrading oil demand. And there is a lot of supply coming, non-OPEC and OPEC. We think the Ukraine-Russia war gets sorted. There is talk like Trump will go after Iran, which is potentially a good thing for if you're invested in oil. And so, yeah, like the demand's not there. The supply's coming online. More and more supply. OPEC keep holding back because they know the oil market would fall even further. The one thing that gets us interested is when we talk about positioning, everyone is negative on oil. So we want to get positive on it just because everyone's negative on it, but we just can't find the reason yet. Once we get that reason, there is a very quick trade in oil, in energy, and I think we'll get opportunities throughout 2025. But from a fundamental point of view, the demand supply, it's really hard to get too positive on energy. So we have a small holding in Santos because, again, we think it's very undervalued, and a bigger holding in Woodside. Again, not near like benchmark or index like, but we just think they're so cheap on a relative basis that it's worth holding them in, because once these events happen, political events or geo events happen, it's too late to invest in them before they happen. So we just want to have an exposure because everyone is so negative on them.
And quickly, when we talk about learnings over the last year, that's a sector we took some learnings from, where sentiment had shifted so negatively. Even when oil price would rally, the stocks wouldn't rally. That wasn't a battle we needed to pick. So hence why we've reduced that, and we're hoping that there will be an opportunity to get back there where the macro provides a tailwind.
Collins asks, when you talk about your copper positioning, does that include BHP?
Yep, absolutely. The biggest copper producers in the world, the conversation includes BHP and Rio Tinto. Just the unfortunate aspect of it is they're dwarfed by the iron ore earnings. So yeah, they have material copper. So does Newmont. It's got a material copper exposure, but again, that's dwarfed by the gold exposure. So you find when copper runs, it's the pure play copper stocks, be it Sandfire or Capstone, are the ones that have the most immediate leverage versus the BHP Rio or South 32.
Kathy's asked, what's been the impact of private equity buyouts on many ASX listed equities on your stock selection?
They haven't completed in a few of our sectors, which has been problematic, but undoubtedly we're going to see more of that take place. Private equity are cashed up, they need to deploy, but what's prohibited them from being more active than what they are is exits, because they need to rotate their own portfolios, and they haven't had traditional tools being IPOs to exit their existing positions. When we see that opening up, the IPO market would probably see more and more activity. I think a few of the vintage 23 acquisitions for private equity haven't done as well as they probably hoped. But they, again, go back to the original premise, they are cashed up. And if we do continue to see the divergence in valuations in the ASX, we will expect more of the cheap, undervalued companies potentially be taken over.
George has asked, could you please comment on your reasons for buying Sonic Healthcare?
Yeah, I mean, Sonic's one we've been watching for a while, and the reason why we bought into it was we began to see a pickup in their path volumes. So after COVID, we thought that would pick up quicker than it did, and it just didn't, and it lagged for a long period of time. So for us, we were watching Sonic. It's always been on the radar. They've had a couple of profit warnings throughout the last couple of years, and it's really off the back of path volumes not returning to levels, and also COVID testing rolling off, because they got all the benefits of COVID testing during that period. So for us, it was just purely on fundamentals, path volumes returning, and we were very much that wasn't in the Sonic share price, and we bought it up. We have been reducing it a little bit, but the fundamentals are still solid, and we expect that to continue from now.
The next question comes from Michael. He says, clearly there's this tug of war in the private health insurance and private hospital universe, with government restrictions on insurance premium increases at one end and ageing population and health needs on the other end. How do you see Ramsay Health Care's future prognosis in this battle?
Yeah, this is a really, really tough space right now. I think the right way to characterise it is exactly what you said, Michael. It's a tug of war. And how that ends or how it changes is very difficult to see, given the government's willingness to come and intervene is very low. If you take the extreme scenarios, and that being there are some private hospital operators going bust, and the one that a number of market participants are alluding to is HealthScope, which has some issues, that could rebalance the industry, because ultimately what it comes down to is volume growth isn't strong enough to offset the cost pressures that the hospital businesses are facing. Rightly so, our nurses need to get paid more, and they are getting paid more. And the EBA agreements that they're signing lead to 4 to 5% wage increases that the hospitals need to wear. Now, typically the way that they can absorb that is through efficiency and volume. But given more and more beds have been opened up in the private hospital space, that efficiency isn't leading to the recovery of those costs. So the pushback from the hospital operator is, hey, Mr. Insurance Company, give us more money. And the equation of profitability has certainly shifted from the hospital provider to the insurance provider. And I think if you go back in time, it typically was a 70-30 profitability split that would go to the hospital provider, and a 30% profitability would go to the insurance company. That's skewed completely the other way now, and it's 90% of the profitability in the industry is going in the insurance space, and 10% is going to the hospital operator. And of that 10%, around 5% of it's going to Ramsay, whilst the rest of the space is typically non-for-profit or loss-making. So there needs to be something done. What that is going to be, it needs to be something extreme for it to to change. Otherwise, we're going to have this tug of war continue for the next 2 to 3 years, and the profitability of hospital operators is going to struggle.
Thanks, Matt and John. The last question's come through, and it's directed for Geoff. You've been buying WAM Leaders and WAM Capital lately. Can you explain why this is the case?
Yeah, well, I like the idea of buying $1 of assets for less than $1. One of the things that I was going to mention earlier, one of the great things about the listed investment company space, as distinct from an open-ended trust company space, you've actually got a competitive advantage because the people managing the money can take medium, long-term views and never force buyers when the money flows in to the open-ended company structure or flows out. So for Matt and Johnny and the rest of their team, around the corner in the office, that it's they've got a pool of capital that they can take medium, long-term views, even though they do adjust the portfolio consistently and very regularly. And why have I been buying WAM Leaders? I'm buying some WAM Capital. I'll probably buy some WAM Global. I'm just the ones that are discount because we've just recently gone ex-dividend and as I mentioned, you tend to get outperformance from the announcement of the dividend to when you go X, and then you get a bit of selling, where people or lack of buying, and there has been a reasonable sized seller that's been weighing on the stock, and that they've moved as well. And for me, this period, from the early January, if the boards are confident, if there's a good result or re-dividends, what might happen, and it has happened historically, is the various boards of the various LICs have decided they want to come out early and announce their results in terms of performance or B, their dividends, and it's then I can't buy around that period, so I've got to buy before that. So that's the logic. And I know that was the last question. There might have been some other questions that have come in that we've missed or haven't answered. Look, there was, I think 141 questions I can see on one of the screens. So thank you very much. If we haven't got to your question, we will come back to you. Thank you for your interest. It is your company. I know a shareholder said, look, I'd like to see the top 20, and Matt and Johnny mentioned that, on the monthly NTAs, we changed from the top 20 to show where we're overweight or underweight. The top 5 overweights or the top 5 underweights. Maybe we expand that to the top 10 overweights and the top 10 underweights, and maybe that'll get you the top 20. But I mean, we'll work out how we communicate that to you most effectively. Obviously, everyone, have a great Christmas. Be very safe. And as I said, this is your company. So any questions, thoughts, or comments, please email us, call us, or give us some feedback, and so we can adjust things. Thank you.